Hi there. So let's talk about issuing stock. Alright, so we know that companies issue stock, and obviously it becomes part of the capital of that company, and it has to go under stockholders' equity. So how do we do those transactions? What do those journal entries look like? That's what we're going to talk about. So first thing we need to understand is how stock gets issued, how that works. Large corporations need huge quantities of money. They cannot finance all of their operations through borrowings, so they raise capital by issuing stock. A company can sell its stock directly to stockholders, or it can use the services of an underwriter. An underwriter is a firm that handles the issuance of a company's stock to the public, usually assuming some of the risk by agreeing to buy the stock if the firm cannot sell all of the stock to its clients. The amount that the corporation receives from issuing stock is called the issue price. The issue price is the price of the stock initially sells for the first time it's sold. So obviously companies have some stock authorized. They decide, oh, we're going to sell some of this to raise some capital. So they sell it either directly or through an underwriter. And we got to put that on the books, right? Because cash is going to come in, right? So we got to get that cash on the books. How do we do that? Pretty simple. Cash and common stock. All right. Smart Touch Learning. Here's an example. Smart Touch Learning common stock carries a par value of $1, and the charter authorizes 20 million shares of common stock. The journal entry includes a debit to cash of $15,000 and a credit to common stock for $15,000. So in this case, we authorize the stocks and we issue it at par value. Maybe that happens, maybe it doesn't. A lot of times this happens when companies first start, right? You've got a small company and you're issuing it to the 3 or 4 people who started the company, and they just issue it out at par value because it's theirs anyway. So you put in cash and common stock, $15,000. So that's just par value, issue it. We're not issuing all of it, right? Because we're authorized for 20 million. We're only issuing 15,000. All right? But it's a pretty simple transaction, cash and common stock. Now, obviously, a lot of times it's going to be at more than that. So, especially when they're issuing it to people outside the company. So, it's going to sell for more than its par value. So, let's imagine Smart Touch sells 3,000 shares for $5 per share. So, there's a difference of $4, right? So, we got to account for that. All right. So how much cash do we get in? Well, we sold 3,000 for $5 per share. So we get in cash of 15,000. But we put common stock $1 times 3,000. So common stock is 3,000. So it's kind of similar to the last transaction. You put that par value part down. Then anything extra, that $4 per share, that's called paid in capital in excess of par. All right, and that is the 12,000. So, as stated previously, most corporations set a par value low and issue common stock for a price above par. The amount above par is called a premium. Assume Smart Touch Learning issues an additional 3,000 shares at $5 per share. The $4 difference between the issue price and par value is a premium. The premium on the issue of stock is not a gain, income, or profit for the corporation because the company is dealing with its own stock. The premium is another type of paid-in capital account known as paid-in capital in excess of par. It is also called additional paid-in capital. Paid-in capital in excess of par represents amounts received from stockholders in excess of par value. The journal entry includes a debit to cash of $15,000, a credit to common stock of $3,000, and a credit to paid-in capital in excess of par common, $12,000. So this exhibit shows how we would show that on the balance sheet. So up to now on the stockholders' equity portion, we've really only had common stock and retained earnings. So now we're going to sort of expand that a little. Now we're going to have paid in capital, and then we'll show how much is common stock and how much is paid in capital in excess of par common stock. Right? So we kind of split that out. Right? So a little more detail on the balance sheet there. Now, let's assume their common stock is no par. All right? So what happens? When a company issues no par stock, it debits the asset received and credits the stock account. So for no par stock, there can be no paid in capital in excess of par because there's no par to be in excess of. Assume that instead of $1 par value, Smart Touch Learning common stock is no par. Regardless of the stock's issue price, cash is debited and common stock is credited for the cash received. So while the total paid in capital of $30,000 remains the same, the common stock account differs from $18,000 par stock to $30,000 no par stock. So your paid in capital looks slightly different. There's just common stock. There's no such thing as paid in capital in excess of par. And of course, retained earnings is still retained earnings. So this is page 652, shows you how the balance sheet would look. And of course, our other choice besides par value stock, no par value stock, we can have what's called stated value. So it's pretty much like par, except for they use the account as paid in capital in excess of stated value. That's about it. So, accounting for stated value common stock is almost identical to accounting for par value stock. The only difference is that stated value stock uses an account titled paid in capital in excess of stated to record amounts received above the stated value. For example, assume that instead of issuing 3,000 shares of $1 par value for $5 per share, Smart Touch Learning issues 3,000 shares of $1 stated value stock for $5 per share. So Smart Touch records a debit to cash of $15,000, a credit to common stock, $1 stated value of $3,000, and a credit to paid in capital in excess of stated common of $12,000. So it's looking a lot more like the par value one. Okay. And finally, especially when companies first get started, like owners will chip in stuff like, oh, I'm going to chip in my computer, and I'm going to chip in my office furniture, and I'll take stock for that. And so sometimes, and a lot of times at like the high-tech companies, when they're first starting out, people will work, and they'll chip in work or something. So you have to record common stock for assets other than cash. Not a lot, but sometimes it can happen. And so the corporation and the person who's chipping in the thing, whatever it is, a machine, they agree to how much stock they get. So a corporation may issue stock for assets other than cash. Looks like this. It records the transaction at the market value of the stock issued or the market value of the assets received, whichever is more clearly determinable. Smart Touch Learning receives an additional contribution of furniture with a market value of $18,000 in exchange for 5,000 shares of $1 par stock. As you can see, the common stock is still recorded at its $1 par value, and the difference between the market value of the furniture and the par value is recorded as paid in capital of excess of par. The contributed asset is recorded at its current market value. So instead of cash, we got furniture. That's really the only difference. So preferred stock. So we talked about the two classes, common and preferred. So let's remind ourselves, preferred stock means you have a little bit of an advantage over the common stockholders. You get maybe your dividends first, you get your liquidation first, and a lot of times you get a specified dividend amount of a certain percentage. So yeah, that's definitely an advantage, so we call it preferred stock. Accounting for preferred stock follows the pattern illustrated for issuing common stock. Assume that Smart Touch Learning has authorized from the state to issue 2,000 shares of preferred stock. Smart Touch Learning decides to issue 1,000 of its $50 par 6% preferred stock on January 3, 2017 at $55 per share. The 6% in the description refers to the stated dividend associated with the stock. So this case, right, we're getting in cash, we're putting in preferred stock, and then paid in capital and excess, whatever's above the par value, or, could be stated value. And we put it on the books, we get our cash in, and there's our transaction. What it looks like on the balance sheet is like this. So in your paid in capital section, you'd have preferred stock, paid in capital in excess of par preferred, common stock, paid in capital excess of par common stock, then your total paid in capital, and then our retained earnings. So now we've really subdivided that stockholders' equity section into the different kinds of stockholders' equity. All right, so that's it for Class 34, Monday, Wednesday, Friday. Class 24, Tuesday, Thursday, folks, you guys are going to continue on. Class Monday, Wednesday, Friday, we'll see you on Class 35.